Are you wanting to buy in Oregon, but you don't know how to afford a house with the interest rates that seem to fluctuate by the hour? If so, I'm going to give you 5 ways to get around the mortgage rates and get you into the home that you want today. Hey everyone, I'm Joe Skipper with Skipper Realty Group, brokered by eXp Realty out of Oregon, and I'm going to share with you some of the top ways people are navigating around their mortgage rates and getting their Oregon home. And if you're a buyer, seller, or an investor and you want to stay up to date with the latest on the housing market, you should like and subscribe to this page. I put out content regularly so that you can go into the home investment journey with the most knowledge so you can make the best financial decisions for you and your family. Okay, let's start with one that's increasingly popular, especially now that rates have gone up a lot, and that is seller carried financing. So seller carried financing, also known as seller financing or owner financing, is a real estate transaction where the seller acts as the lender and provides financing to the buyer instead of the buyer obtaining a traditional mortgage from a bank or a lender, just the more traditional way. In this arrangement, the seller essentially becomes the mortgage holder and the buyer makes monthly payments directly to the seller, typically with an agreed upon interest rate and repayment terms. So there are some real pros to seller carried financing. Seller financing can provide an opportunity for buyers who may have difficulty qualifying for a traditional mortgage due to poor credit history, you don't have a big down payment, or various other reasons. Seller carried financing allows for more flexibility in negotiating loan terms. Buyers and sellers can tailor their repayment schedule, interest rate, and down payment to meet both of the needs. This flexibility can be particularly beneficial for buyers who need more time or a specific arrangement to secure a traditional mortgage. Seller carried financing can streamline the home buying process since it eliminates the need for extensive paperwork, credit checks, and underwriting processes associated with traditional mortgages. This can result in a faster closing process and reduce closing costs. Now, having said that, lawyers have to get involved in these transactions. You want this transaction to be solid legally and want all your bases covered, so don't overlook the paperwork aspect of this portion. In certain situations, the terms of seller carried financing may be more favorable than what a buyer could obtain from a traditional lender. Buyers might secure a lower interest rate, avoid certain fees, or negotiate a longer repayment period, depending on the agreement reached with the buyer and the seller. Now, there are some cons to seller carried financing. Sellers who offer financing often incorporate the potential risks and carrying costs into their sales price of their property. Consequently, the purchase price may be higher compared to similar properties in the market. So buyers should be carefully evaluating whether the benefits of seller carried financing outweighs that potential cost increase. Also, buyers need to assess the financial situation and creditworthiness of the seller before entering into a seller carried financing agreement. Now, if the seller encounters financial difficulties or defaults on their obligations, it could pose a huge risk to the buyer, potentially resulting in foreclosure and loss of that property. Again, it's why lawyers need to be involved so that you are protected on both ends. Now, not all sellers are willing or able to provide financing to buyers. So this limits the pool of available properties for buyers who exclusively are seeking seller financing options. It may require more extensive searching or waiting for that right opportunity. Seller financing often involves shorter-term loans with a balloon payment due at the end of the loan. So buyers need to plan for this large lump sum payment or secure refinancing before that balloon payment is due so that they can avoid potential financial strain or the risk of losing that property. Now, seller carried financing can be a viable alternative for buyers and sellers under the right circumstances. However, it's crucial for both parties to thoroughly understand the terms, risks, and implications involved with it. So, it's important to consult with real estate professionals, attorneys, and/or financial advisors so they can provide valuable guidance throughout the transaction to ensure a mutually beneficial arrangement. On to the next, house hacking. House hacking is a real estate strategy where homeowners live in a multi-unit property and they rent out the additional units to generate the income. It offers several advantages and disadvantages that are worth you considering. So some of the pros are the rental income to offset the expenses. House hacking allows you to collect rental income from the units you're not occupying. This income can help offset your mortgage payments, property taxes, insurance, maintenance costs, and it makes homeownership more affordable. By using the house hacking strategy, you can start building equity in a property earlier in life. As you make mortgage payments and property values appreciate, you can benefit from the potential long-term wealth accumulation. Lower housing costs. House hacking can significantly reduce or eliminate your housing expenses. By renting it out the other units to other people, you may cover the majority, if not all, of your mortgage costs, allowing you to save money or invest in other opportunities. The rental income generated from house hacking can boost your overall income, potentially improving your loan qualification when you decide to move on from this property. The increased income can make it easier to secure financing for future real estate endeavors and different investments that you have. House hacking provides an opportunity to gain first-hand experience in managing a rental property. You can learn about tenant screening, lease agreements, property maintenance, and other aspects of the real estate management system, which can be valuable if you plan to expand your real estate portfolio in the future or become an investor. Now, there are cons to house hacking. You sacrifice privacy and personal space. You live in close proximity to your tenants. That means sacrificing your privacy and personal space. Dealing with tenants' issues, noise, and potential conflicts can be challenging, especially if you prefer to live a more private life. House hacking typically requires specific property types such as duplexes, triplexes, or fourplexes, which may limit your options depending on the location and availability of those properties in your area. As the property owner and landlord, you're responsible for finding and managing tenants, maintaining the property, handling repairs, and ensuring compliance with local regulations. This added responsibility can be time-consuming and require significant effort and organization. Tenant turnovers and vacancies can impact the profitability of your house hacking. If you struggle to find reliable tenants or experience frequent vacancies, it can disrupt your rental income and put financial strain on your ability to cover those expenses. House hacking ties your housing situation to an investment property. This lack of flexibility can limit your ability to relocate or change your living environments easily, as you may need to consider the impact on your rental income and property management. So, before embarking on a house hacking journey, it's essential to thoroughly evaluate your financial goals, lifestyle preferences, and real estate market conditions. Consider consulting with a real estate agent and a financial advisor to assess the feasibility and potential benefits of house hacking in your specific situation. Down payment assistance programs and first-time homebuyer programs are designed to help individuals overcome the financial hurdle of making a down payment and facilitate your homeownership. So let's look at the pros and cons of these programs. So some of the pros of the down payment assistant and first-time homebuyer programs is that they offer increased affordability. These programs provide financial assistance to homebuyers, allowing them to secure a home with a lower down payment or even no down payment at all. Now, this increased affordability can make homeownership more accessible, especially for individuals with limited savings. By reducing the amount of money required for a down payment, these programs alleviate some of the immediate financial burdens associated with purchasing a home. This can free up funds for other expenses, such as moving costs or home improvements that you may have to make. Down payment assistance programs and first-time homebuyer programs, they often have relaxed eligibility requirements, which makes them more accessible to individuals who do not or may not qualify for conventional mortgage products. These programs typically consider factors like income, credit score, and homeownership history, which makes it easier for individuals with limited resources or lower credit scores to enter the housing market. So, potential for favorable loan terms. Some down payment assistance programs offer additional benefits such as lower interest rates or flexible repayment terms. These advantages can result in long-term savings for home buyers by reducing the overall cost of the mortgage. Also, many of these programs offer educational resources, counseling, and workshops to guide first-time homebuyers through the process. This support can provide valuable information on budgeting, financial management, and homeownership responsibilities, which empowers buyers to make informed decisions in the future. Some of the cons is that they're limited availability. The availability of down payment assistance programs and first-time homebuyer programs can vary by location and funding availability. In some areas, these programs may have limited funds or stringent eligibility criteria, making it challenging to secure the assistance. Some programs have income limitations, which may exclude higher income individuals from accessing these benefits. Eligibility requirements vary by program, so it's important to research and understand specific criteria for the programs that you are considering. Certain programs may impose restrictions on the type of property you can purchase or require you to live in a home as your primary residence for a specified period. These restrictions may limit your flexibility and ability to sell or rent the property in the near future. Also, these have additional paperwork and administrative processes. So by participating in these programs, they often involve lots of paperwork, lots of documentation, and lots of the admin process. The application and approval process may be more complex compared to the traditional mortgage application, requiring extra time and effort on the part of you as the home buyer. Some of the programs come with certain terms and conditions that may have long-term financial implications. For example, shared equity programs, they may require the homeowner to share a portion of the property's future appreciation when they do sell. So it's crucial to thoroughly understand the program's terms and assess their potential impacts on your future financial goals. So when considering down payment assistance and first-time homebuyer programs, it's essential to research and understand the specific programs available in your area, their requirements, benefits, and any drawbacks. Consulting with a mortgage professional or housing counselor can provide valuable guidance in navigating these programs and determine what's best for you. Okay, let's move on to a bridge loan. A bridge loan is short-term financing option that helps bridge the gap between the purchase of a new property and the sale of an existing one. It can provide funds to cover the down payment or closing costs on the new property while waiting for the sale proceeds from the old property. So let's explore the pros and cons of a bridge loan. A bridge loan allows homeowners to proceed with the purchase of a new property before selling their current one. Obvious benefit. This can be advantageous when timing is crucial, preventing the need for temporary housing or the risk of losing out on a desired property. By using a bridge loan, home buyers can access funds for a down payment, or they can use it for closing costs on the new property without relying solely on the sale proceeds from the old property. This increased buying power can potentially open up more options and help you secure the desired property that you want. Bridge loans often have flexible repayment terms. This allows borrowers to repay the loan once the old property is sold. This flexibility can alleviate immediate financial burdens and provide you with more time to complete the sale on favorable terms. While bridge loans typically have higher interest rates compared to traditional mortgages, they're usually short-term loans. This means the overall interest cost may be relatively low, especially when considering the convenience and flexibility that they offer during that transitional period. So, the cons? Bridge loans often come with higher interest rates, origination fees, and other associated costs compared to conventional mortgages. These additional expenses can add up, potentially increasing the overall cost of home ownership. Now, depending on the real estate market condition, there's a possibility that the old property may not sell as quickly as anticipated. So, if the sale is delayed or falls through, borrowers can face challenges repaying that bridge loan within the agreed upon time frame. This could again lead to increased financial strain or the need for alternative financing options. Lenders typically have stringent requirements for bridge loans approvals, including factors such as creditworthiness, income, and equity in the existing property that you're selling. So meeting these requirements can be challenging, especially if there are uncertainties regarding the sale of the old property or if the borrower's financial situation is not that strong. Bridge loans are subject to market conditions. If the real estate market experiences a downturn or there's a lack of demand for the old property, it could prolong the selling process and increase the risk associated with carrying two properties at the same time. Also, bridge loans may not be offered by all lenders, and they vary based on the ability of location and market conditions. It's essential to research and identify lenders who specialize in bridge loans and carefully evaluate their terms and conditions. So before considering a bridge loan, it's important to assess your financial situation, evaluate the real estate market, and carefully consider the potential risks and costs associated with that type of financing. So consult with a mortgage professional or financial advisor, and they can provide you valuable guidance in determining whether a bridge loan is right for you in your specific circumstance. Mortgage rate buydowns. So mortgage rate buydowns are a strategy where the borrower pays additional upfront fees to lower their mortgage interest rate for a specified period, typically the first few years of the loan term. So let's discuss the pros and cons of doing a mortgage rate buydown. So one of the pros is lower initial mortgage payments. So by securing a lower interest rate through a rate buydown, borrowers can enjoy reduced monthly payments monthly during that initial period. This can provide more financial flexibility and potential increased affordability, particularly for first-time homebuyers who may have that tighter budget. Lower mortgage payments result from a rate buydown can improve a borrower's debt-to-income ratio. This potentially allows them to qualify for a larger loan amount. So this increased purchasing power can open up more options and help a buyer secure a home that meets their particular needs. Now, although rate buydowns require upfront fees, they can lead to long-term savings if the borrower plans to stay in the home for an extended period. The reduced interest rate can result in significant savings over the life of the loan, so it offsets the initial cost of that initial buydown. Lower mortgage payments that result from a rate buydown can free up cash for other purposes, such as saving for emergencies or making the home improvements on your new home or investing in other real estate opportunities. This improved cash flow can provide more financial stability and flexibility and confidence. But there are some cons. The upfront costs. Mortgage rate buydowns require borrowers to pay upfront fees, often referred to as discount points, to secure the lower interest rate. These fees can be a significant upfront expense, and borrowers must carefully consider whether that long-term savings justifies the immediate cost of that. The savings from a rate buydown may take some time to surpass the upfront cost. Borrowers should calculate the break-even point, considering factors like the duration of the time they plan to stay in that home and the potential savings achieved through that lower interest rate. so they have a limited benefit for the short term for homeowners. If a borrower plans to sell or refinance the property within a few years, the savings from a rate buydown may not offset that upfront cost. So in those cases, it may be more prudent to offer a higher interest rate without that buydown. Okay, I said 5 tips, but here's a bonus 6th tip, and that is a first-time buyer assistance program. So first-time buyer assistance programs are initiatives designed to assist individuals who are purchasing a home for their very first time. These programs offer various benefits and support to help local buyers overcome financial barriers. So let's discuss the pros and cons of the first-time buyer assistance program. So some of the pros are that down payment assistance. These programs often provide financial assistance in the form of grants or low interest loans to help with the down payment and closing costs. This can significantly reduce the upfront expenses for first-time homebuyers and make homeownership more affordable for them. Some first-time buyer assistance programs offer access to mortgage products with lower interest rates compared to the traditional market rates. This can result in long-term savings and more manageable monthly mortgage payments for the first-time homebuyer. Many first-time buyer assistance programs, they offer educational resources for homebuyer education classes and counseling services. These resources help buyers understand the home buying process, improve their financial literacy, and make informed decisions. So it empowers them through the homeownership journey. First-time buyer assistance programs often have relaxed eligibility criteria, allowing individuals with limited income, lower credit scores, or limited savings to qualify. This expanded eligibility can provide opportunities for individuals who may not otherwise be able to enter the housing market. But there are some cons. So there's limited availability and restrictions. First-time buyer assistance programs may have limited funds or restrictions on types of properties that you qualify for. Buyers have to carefully research and understand the specific requirements, their eligibility, and limitations for these programs. So there's a lot of additional paperwork and processes. Participating in these programs may involve additional paperwork, documentation, and administrative stuff. Buyers need to be prepared for the additional requirements that come with that and make sure they meet all the program's obligations. So they may have an impact on future home buying. Some first-time programs impose resale restrictions or equity sharing provisions. So these restrictions may limit your ability to sell or rent the property in the future, and it potentially impacts their plans for future real estate endeavors. The availability and continuation of first-time buyer assistance programs are subject to funding and government policies. If funding is reduced or discontinued, it may limit the options for first-time buyers in the future. So before participating in a mortgage rate buydown or the first-time buyer assistance program, it's critical to carefully evaluate the specific terms, costs, and benefits, and the limitations of the programs available in your area. So consulting with a mortgage lender, a housing counselor, can provide valuable guidance in determining the sustainability and potential advantages of these programs for your circumstances. Okay, there you have it. These are some great options to navigate today's market and interest rates, and hopefully it'll give you enough information to get you in the home that you want today. Now, if you need to talk to a lender or have any questions about these options, reach out to me and I can put you in touch with some of the best around. And if you guys are looking to buy or sell in the next year, give me a call and let's talk about what it takes to get you the highest return on your investment when you decide to go that route. This market is always changing, almost daily. So to have an expert guide you through it is one of the best choices that you're gonna make. Also, don't forget to subscribe and like this page so that you can stay up to date on the latest on the Oregon housing market. Thanks, guys.